Hello, everyone, and welcome back to the second episode of Ask Anthem, the podcast where we break down the complicated world of taxes and strategy and make it simple for business owners, families, and today, athletes. I'm Gavin, and this episode is all about something we've been seeing more and more, and it's about how state taxes can affect athletes who earn NIL income. And the reason we decided to cover this topic today is because we have seen an issue in this process with where these colleges are giving these, young 18, 19, 20-year-old kids, pretty big amounts of NIL money, and they're not given the education in order to be able to, deal with the implications of that and file that within the different states they play, and stuff like that. So, yeah, today we have Tyler Coates here to help us unpack this. He's a senior staff accountant here at Anthem Strategists and works closely with our NIL clients. Tyler, welcome to the show.
Thanks for having me. Look forward to speaking my word a little bit about NIL taxes and hopefully helping some athletes.
That's the goal. Sweet. So the first question I want to ask, I kind of want to start off simple, and I want to talk about what is the jock tax and why should athletes care?
Yeah, that's a great point. So the jock tax is a stance that we're taking here at Anthem, voluntarily, I guess you could say. But what the jock tax is, it's reporting your income that you earn to all the states that you played in. What I mean by that is if you play at Oregon State, half your games are at least in Oregon because you're home games. But you also play in Washington, California, Arizona, Colorado, wherever their schedule has a game. And there's there's states that want a chunk of their tax. So it's easy to trace an athlete's games where they played at. You go look at a box score and you're like, oh, Gavin had 2 touchdowns in California. He must have been here. It's pretty easy to find out if an athlete played in another state because of box scores. So that's jock tax is a way to allocate your income to different states, not 100% of it to your domicile state.
And that's interesting because I feel like with my experience when I used to play college football, I feel like a lot of these kids or athletes who, are every other weekend going to a new state to play, they have no idea this is even a thing.
Well, the other thing is, like, not only do you have state income tax, but you might have a city tax. If you play in Portland or New York, we do extensive research when we don't just ask the client what state did you play in, we ask for the city as well because there's also city taxes that can be a liability for clients as well.
Dang, that's crazy. So yeah, I've heard kind of the whole idea of the jock tax actually started with Michael Jordan. Is that true? And can you explain, the story and how it led to the current system we see and, where state taxes are visiting athletes?
Yeah, no, it's a great point. So yes, thankfully, because Michael Jordan played in the NBA Finals, I think it was 1981, the Chicago Bulls played the Los Angeles Lakers in California. And the state of California didn't like the idea that a player from another state was coming into their state, a high earning taxpayer was coming into their state to perform a service, which is play a basketball game, and was leaving the state without having to pay any tax to that state. State of California didn't like that, and now we have the jock tax. It's not just the state of California; it's all states apply the jock tax.
That's interesting. And so, how did that turn into something that now impacts not just NBA players but college athletes as well?
Like I mentioned earlier, it's the box score, so it's it's really any athlete that performed a game or had a practice or a team organized activity or an event. I mean, really, your tax dollars are taxed in the area that the services were performed or the product was sold. And so in this case, it's a service. So if you're a swimmer and you go to a swim meet in California, there's probably going to be a ranking or you'll know who placed what record. They'll be on ESPN. Like, it's easy to trace where a athlete performed that, competed in that sport, and the outcome of that event. So it's not just the NBA. It applies to any athlete because there's just so much coverage for it.
So any sport where they're earning revenue.
Correct.
From it's good to know. So kind of switching the topic a little bit, I want to get into how NIL triggers multi-state tax issues. And more specifically, I want to know, so NIL income isn't just about how much you make, it's about where you make it, correct?
Correct. Yeah, exactly. So, like I mentioned, you could live in Texas, which is a no state income tax state, and think, oh, sweet, I don't have to pay any state income tax because I live in Texas, which is half correct. For the games that you played in Texas, so let's say you played 10 games and 5 of them were in Texas, half of your income is allocated to the state of Texas, which is deemed a no state income tax. So you don't pay tax for Texas. However, if those other 5 games are played in Oregon, 2 in Oregon and 3 in California, you now have Oregon and California state income tax. So it can be misleading. Oftentimes, whether it's a joke or not, you'll hear athletes say, I'm interested in going to Florida. I'm interested in going to Texas. Those are states with no income tax. So they think, oh, I'm avoiding state income tax, which is true. You're just not avoiding 100% of state tax because your income then gets allocated. It's called a duty day reporting. And the duty day reporting says, okay, I played 10 games, 5 of them were in Texas, and the other 5 were in these other states. So then we allocate the income to those states based on how many days you were there. And the interesting thing is, it's not just the day that you play the game. You usually fly in the day before the game, if it's football related, fly in the day before the game, play the game, and then either leave that night or the following night. So you could spend 2 days per game in that state. So it's not just the day of the game, it's the entire trip. If you're a college athlete and you play in a bowl game, you go to a state for 7 days, we're now allocating 7 days of the entire year to that state. And then the other thing that we need to take into account is the days that they're not an NIL athlete, which is kind of gray, and leaves room for the athlete to make that call. But if you're not an NIL athlete, which means you're not keeping up with recovery, keeping up with social media, lifting weights, practicing, which if you're a high-level athlete, you're almost doing that every day.
Essentially like their off days.
So, there may be off days, there may not. It just depends on the client. But
I think that's really good that you touched on that topic, because from my experience, being around these athletes that get this NIL, I think a common misconception is that, oh, if I live in Florida, I'm going to be missing out on all these state taxes. When in reality, the IRS is going to get you one way or another.
And the states too.
So
it's it can be really misleading to athletes. There's a lot of false advice out there. We even hear athletes have been given advice of, well, if I live in Oregon, but I register my LLC in Texas, since Texas is a no state income tax, then I'm good. It doesn't work that way. It's where the services were performed, which is your games. So just highly advise athletes to reach some advice from a tax professional.
And I think especially this might apply to, sports that aren't just 12 games in a season, where, baseball or basketball where they're playing, especially like the MLB where they play 180 games a year. That'll add up. There's a lot of different states they play in.
It makes the tax filing very complex.
Another thing I kind of wanted to touch on is, are there certain states that are more aggressive than others when it comes to the jock tax, like where athletes should really be putting emphasis on paying attention to it?
If we're going to take the stance that we're going to do the duty day reporting and we're going to do the jock tax, we're going to be compliant with jock tax. It's not like, okay, we only got to do it for this state and maybe not these states. If we're going to do it, we're going to do it for all states. That's being compliant. But I would say maybe states with the higher income tax will maybe be more on top of it, like a California, Pennsylvania, New York.
Makes sense.
But in terms of Anthem and our strategy is, we're going to do it in every state, not just because one state. We heard a story of one state being more aggressive or another. We're gonna apply it to all states.
Okay.
And then the other important thing is, if the nice thing about, well, it depends. It could be nice or it could be a disadvantage. If you play so let's say you live in Oregon, but you play a game in Texas. You would think that those days are applied to Texas because just like we're applying it to the other states. I was there for 3 days, so 3 days of my NIL days are going to be thrown to Texas. Well, Texas doesn't have state income tax. And so because of that, those days are what's called thrown back to your domicile state. So if you play in Oregon, just because you went and played in Texas doesn't mean that those days are now not subject to a state income tax. We're throwing those days back into the Oregon pile of days and adding that to the Oregon total days that you spent in that state. So that may be a disadvantage to someone that lives in an income tax state. But let's say you live in Texas.
Mm-hmm.
You know, you play a couple days in Oregon, you play a couple days in California. Those days will get picked up and pay income tax to those states. But if you live in Texas and then you play in Florida, well, there's no Florida income tax, so we throw those days back to Texas. Well, there's no Texas tax, so you're fine. Well, not fine, but you don't pay Florida state income tax. So it gets really deep and very complex.
Dang, I didn't know that either. So next thing I want to talk about on a more kind of broad NIL scale is since I know you work with athletes one-on-one a lot, obviously very frequently, and you've dealt with this a lot. So what are some of the biggest mistakes that you see athletes or their families make when it comes to either NIL in general or, you know, jock tax specifically?
I mean, number one is not understanding the model of being an independent contractor, being self-employed, which is the avenue that these NIL athletes are headed down. And what I mean by that is they're not having withholdings withheld from their 1099 income. If you're an employee, you know, whether you work at Nike, McDonald's, Walmart, Anthem, you're on a monthly, weekly, or biweekly payroll, and each time you get paid, you have a withholding from your pay. You know, your gross pay may be $5,000, but only $3,800 comes to your checking account. Well, that's because a portion of that difference is covering a portion of your tax liability, whether it's income tax, FICA tax, all of those things. And so now that you're an independent contractor, you're self-employed, those things aren't happening unless you set them up.
Because their business is essentially themselves.
Right. So. And so when you're an independent contractor, you aren't having taxes paid in throughout the year like an employee would. And so to make up for that, you need to pay quarterly estimated tax payments throughout the year. It's not a requirement, but it's a suggestion. If you don't make your quarterly estimated tax payments enough, then you'll be subject to an underpayment penalty. So that's the first thing, is clients end up paying more in tax than they needed to because they didn't know about the estimated tax payments. You know, our taxes due April 15th, but the payments, the amount that you pay in, and it depends on how much you make, so it gets pretty complex. But for most, well, not most, but for someone that makes under $150,000, your tax payments need to be paid in 90% of last year's tax. So if you paid $100 in tax last year, $90 of your tax needed to have been paid in throughout that current year. If it wasn't paid in, and evenly, quarterly, if it wasn't paid in that way, then that's when the underpayment penalties apply.
And so that other 10% you can pay.
Because like, you know, they're not going to make you pay 100%. Now, if you are it depends on, they compare your current year and your prior year tax. So it's not black and white. It's very situational, but it's something we look at. You know, we have to look at. So that's the first piece, is clients not understanding the generation of underpayment penalties. And then the second thing would be not understanding the cash flow piece of their tax liability. You know, you receive $100,000 of NIL income today, but don't have your tax liability is technically not due until April 15th. That leaves 8-10 months to just blow $100,000. You know, I'm going to give mom and dad some, I'm going to give my girlfriend some, I'm going to give my friend some, I'm going to buy a couple things for myself. And then all of a sudden it's like, oh, I spent $80,000 and my tax liability is 35, 40, and then they don't have the cash to pay it. So the first thing would be, you know, make sure we're making those estimated tax payments, but then most importantly, we need to shovel some cash away because we have a huge tax liability coming up. And so the estimated tax payments and the big tax payment in April kind of go hand in hand, because if you make your quarterly estimated tax payments on time, you're not going to have a tax bill due on April 15th because you would have paid in. So it's letting the clients know that. Some clients are fine with eating some underpayment penalties and waiting until April 15th to pay their tax. They just need to know in the back of the head, my bank account has 40, 50, 60 grand. but 30, 40 are going to state and IRS payments. So that's probably the most important thing.
Okay.
I want to get across to clients when we first meet with them.
Yeah, that's really good to know. Well, so you just touched on this a little bit, talking about suggesting making the quarterly payments, stuff of that nature. But I'm kind of curious on what other specific things do you do here at Anthem to make sure you're helping athletes avoid these pitfalls?
Yeah, no, it's a great point. You know, most importantly, we want to be educational to these athletes. These are, like you mentioned earlier, most of the times it's 18 to 20, 21, 22, 23-year-old athletes who are receiving massive amounts of dollars.
Yeah.
And maybe earning income for the first time in their lives. It's pretty common to have mom and dad supporting you throughout high school, and then you make it to college, you're on your own, and it's like, here's $100,000, have fun, thanks. And then, they don't know the tax side of things, which is totally understandable. So knowing that, we come in educational first, we want to be proactive rather than reactive, letting the client know, hey, in 8 months, we're going to owe X amount of dollars, rather than like, hey, in 2 days, April 15th, you owe $80,000. So the main thing we can do is educate our clients, let them know what they're getting themselves into, what's coming, and then what we can do to avoid those tags. Here at Anthem, we take huge pride in our advisory services, which are very broad and cover all sorts of different things. But an advisory service is a service that we do with a client that doesn't involve a tax return, but it affects the tax return, which would be, hey, I'm making $200,000 as a NIL athlete. Based off of our prior meeting, you were telling me that I'm going to have some self-employment tax, and you mentioned that there was a possibility to not pay self-employment tax. Can you tell me a little bit more about that? Like, what is that? How do I avoid it? And then that's where our entity structure meeting comes in, and we sit down with an athlete and we let them know, you're an independent contractor. Just as a person who owned a painting business, who does roofing, real estate, whatever it may be, you are now a business owner. There are these things that we can do, to vehicles that we can set up to not be subject to self-employment tax. We explain what that looks like, how they go about doing it, most importantly, what the costs and fees are going to be. We never advise a client to do something that doesn't save them more tax than they would end up paying out of pocket for administrative costs. But that's probably the main thing that we do, is educate them and then advise them.
Okay. Well, taking all that into account, one thing I wanted to touch on is, so for these younger athletes, because I know these days athletes even in high school, can receive compensation. And, just for the people watching, I kind of wanted to hear, for younger athletes or parents that are kind of just getting started with NIL, what's one thing that you think would be the best piece of advice, for them to hear, entering this crazy wild west of NIL?
Yeah, highly irregulated space. First thing I would say is save your money that you're given. You're gonna pay tax, whether it's to the feds and the state or just the feds. You're gonna pay tax, so shovel away, put half of it away, just to be conservative. Put half of it away. If you're gonna make $100,000, look at it at 50. That'd be my first advice. Second advice would be to call Anthem. Email myself, email our business development team, our operations team. Reach out to us. Let us know your situation. It's a complimentary first meeting. We just want to get to know you, hear your situation, see if there's a space for us to help you. Because it all depends on the dollar amount that you're given. If you're given $10 or $10,000 or $1 million, the situation varies in how we can help you at Anthem. So, I would say reach out to a tax advisor. Maybe get a couple opinions on things, because people have different opinions and strategies, and feel it out, and then just be compliant, pay your taxes. You're not gonna get away with not paying your taxes. It seems like, I'm a small fish in a big pond. No, the IRS, if IRS or state,
can get you.
They're gonna come get you. And the reason why it's so easy for them to know, like, people are like, well, how are they gonna know that I got paid? Well, you're issued a 1099. So if I pay you for a service that's more than $600, I have to issue you a 1099. I get a copy of that 1099, you get a copy of that 1099, and then the IRS gets a copy of that 1099. So if I pay you, it's going to say, you know, Tyler Coates paid Gavin LLC $10,000. And it's going to be registered to either your social security number, or if you have an LLC, that EIN, the employee identification number. And so the IRS does a matching principle. First thing that happens when they go through the tax return is, okay, this 1099 had $10,000 of income. Oh, Gavin's tax return doesn't report that $10,000 of income. Huge red flag. So that's how they're going to find you, just based off of that. I mean, that's just a computer and tech doing its thing.
Well, thank you so much. That is a wrap on this episode of Ask Anthem.
Thank you for having me.
Tyler, thank you so much for making this complicated topic make a lot more sense. You know, going forward, if you're an athlete or helping an athlete navigate NIL, do not wait until tax season to figure this stuff out. Head over right now to anthemstrategist.com to learn more about how we can help you, you know, navigate this new journey. And be sure to subscribe so you don't miss out on the next episode for more very educational videos just like this. And if you found this helpful, share it with a teammate, coach, or a parent. Thank you for tuning in, and I hope you have a wonderful rest of your day.
Thanks for having me.